us for this discussion on the private debt landscape in India. Over the past decade, private credit has quietly but decisively emerged as an important pillar of the Indian financing ecosystem. What began as a niche strategy, focusing largely on structured lending and real estate financing, has now evolved into a diversified asset class spanning senior secured credit, mezzanine funding, acquisition funding, and special sits. This evolution reflects a broader structural shift in the Indian credit markets. As banks have understandably become more focused on capital efficiency, compliances, asset quality, certain segments of corporate financing, particularly complex and bespoke credit, has increasingly been served by private debt providers. In many ways, this is exactly how mature credit markets develop. Private credit fills that missing middle, between the traditional banking and the public capital markets. It provides speed, agility, structuring flexibility, and underwriting depth that traditional lenders are often not designed to offer. In India, the opportunity is particularly compelling because the demand for growth capital or special sits far exceeds the supply of flexible credit. India remains one of the fastest growing opportunities, as you heard even from the previous speaker. The GDP growth is expected to be, mid 6% in the coming years. Businesses are scaling up, infrastructure expanding, and real estate sectors like real estate, healthcare, infra, which require, a lot of capital. They need tailored financing solutions, and that's what private credit brings in. In addition, special situations like M&A, private equity exits, bridge to IPO, JV dissolutions, land acquisition financing continue to demand growth of the private credit. From my perspective, working in the debt and special situations practice, we are seeing an important shift in how credit is being evaluated and how it's structured. The early phase of private credit was largely collateral driven. Today, increasingly, we are seeing cash flow funding, business model driven exposures. The investors are spending far more time in promoter credibility, assessing the governance standards of a company, and looking at the cash flow visibility, rather than solely relying on the asset cover. I think this shift is quite actually healthy because the early genesis of the private credit was largely for high yield and stress situation funding, but it is fast evolving into performing credit, and it is meeting the needs across the spectrum. Wherever there's a bespoke solution required, that is where private credit comes in, and we have some of the best experts here who will tell you a little bit more about it in a minute. Sorry. Another important development that we are seeing in this market is the development of the domestic private credit ecosystem. I think up to a few years ago, largely it was the international funds and investors that we found, finding opportunities in India. Today, I think domestic fund managers, institutions, family offices, all of these are increasingly playing a significant role in building a long-term credit platforms in India. At the same time, international investors continue to view this as an attractive market. So this combination, I think, the global capital, domestic expertise, strong economic fundamentals creates a powerful foundation of this asset class. But as you can see, the competition is also increasing. More capital is chasing similar opportunities. Fund sizes are growing, and what we are starting to see is somewhere drips in the thank you. In the pricing discipline and portfolio quality, we are starting to see some dips and some weaknesses emerging there. This kind of brings me to today's core theme. We will explore how private credit strategies in India are evolving, how investors should think about risk and return in private credit, the impact of the recent geopolitical events and the international trends, how domestic and international LPs view India as an opportunity today, and what the future may look like. We have an excellent panel today representing some of the most experienced investors and credit practitioners. Many of them are old friends on this stage, and I'm looking forward to hearing their perspective on where the next phase of India's private credit journey will unfold. Let me start by asking maybe Eshwar, if I may ask you a question. Our panel today has got a mix of investors, right from people who are investing in senior secured, mezzanine, acquisition finance, special sits. Given your fund's focus and, which slices of the capital structure, whether it's senior, junior, whether it's what kind of deal types, growth capital, LBOs, are you finding most attractive now in this current situation in the market?
Thanks, Ashish. So private credit is anything in between senior secured bank debt and common equity. So anything in between that comes under the gamut of what we are calling as private credit. Over here you have performing credit, you have high yield, you have structured buyout, takeout financing, you will have LBOs, you have
real estate and
you have equity takeouts also, and we have focused distress. Of course, distress has been a platform which we have been for many years. I think for the last 25 years I've been in distress, but of late what I have seen, Ashish, is that the distress space has kind of vacated itself, and that's largely because of the IVC coming in, corporate turnarounds which have happened, and of course the equity markets have also played out. And coupled with this, I think banks in general, I have not seen banks who have been so clean and corporate balance sheets been as delivered as they have been in the past couple of years. So our focus has changed from high distress, high yield distress, to more structured financing like takeout financing, share buybacks, acquisition funding, and growth. So that's been the trend right now, and hopefully we don't see a distress cycle again, but that's going to happen for sure. So we'll be all ready, and when that happens, we'll get back to distress as well.
So you remain focused on the distress part of the cycle for private credit. That's what you're saying for your funds.
That's what I like and I love, but unfortunately that opportunity doesn't exist right now.
Just to add to Eshwar, I think from distress it has moved to pre-distress, because the threat of IBC is so strong that if a company defaults, the promoter is definitely going to lose the company. The sponsor is definitely going to lose the company. So what we are seeing right now is promoters being proactive in resolution before getting into an NPA. So that's where the market has shifted to some extent.
Kriti, you can keep the mic up. Maybe I'll just come to you. What we saw last year, in the last calendar year, the Indian private credit deal value was over 12.5 billion, which was 35% over the previous year. And some reports I read say that this financial year will probably end somewhere between 18 to 20 billion in private credit. So with so many new funds coming here and, so much, but India's growth outlook being so bright, the shining star in in the global economy. Of course, we'll come to the recent events in a bit, but do you expect fund sizes to grow further from here? Do you expect smaller funds? There will be some kind of consolidation. I mean, how intense is this competition and what is it leading to as far as investment strategy and philosophy is concerned for funds like yours? I mean, you manage a pretty large fund yourself.
Okay. So on fund size, and especially for platforms like ours and Eshwar's, I think it's a function of the economy, also the function of do we have corporates who can take large tickets, and that's why we say that the fund size will be limited. Any series of fund, I'm saying, not the overall platform fund. Any series of fund may be around, a large platform will be around $1.5 to $2 billion. The reason I'm saying that, if you have a 4-year investment period, the sweet spot which now the Indian corporates can take is somewhere around $50 to $75 billion. So you can have around 25 to 30 deals over a period of 4 years, deploying very peacefully without any pressure. So that's for the larger platforms. For the smaller platforms, I think there's a huge opportunity. Things will come up to the range of 1,000, 2,000 crores. There are opportunities in the smaller ticket size. This is one, the state of economy. The second is obviously the teams, what kind of team strength you have. In order to have a $5 billion platform or $5 billion fund, you also need to have such a large team, and which I think in India right now, some of the large platforms do have that. And the smaller funds, they will take some time to develop into a larger platform. So these are the two functions.
And are you seeing any changes in the risk profile of investments because there's so many more funds now in India which are chasing opportunities, are you seeing some changes shift there, or you are still able to get good opportunities the way what you would like in your portfolio?
No, I think we have learned a lot from what has happened to Indian economy and what has happened in other geographies. So I'm assuming that we are not taking drastic risks. But having said that, we have often seen that when you are in a subordinated position and you are in a private credit business, in a private credit business, the upside is very limited. In a subordinated position, there's infinite downside. You can wipe out the whole capital itself if your deal goes wrong. So it's very important for investment professionals to look at the downside scenario, whether their capital will be protected or not. And that's where I think some may get into a covenant-like model and things like that, which is a classical mistake which people have done in past and one should not repeat here in India.
Hey, Ashish, can I just pitch in on
of course,
both of these points? I think one of your questions also was around consolidation. Is there a need for a consolidation in the space? I would want to make an argument and maybe just take a step back and think about where we are in the private credit space in the Indian context. While the industry has become mature, we have, as numbers throughout, we have around $25 billion of overall AUM in the space now. However, if you look at it from the life cycle of industry's perspective, I think we are still having a significant growth path from here in terms of multifold growth over multiple years. And why I say that? Because I believe we are in a structural growth story as far as private credit is concerned. There are many factors which are playing out. Kirti talked about the underlying growth path from economy perspective. India is growing at around 10-11% nominal growth. If you look at, and Eshwar touched upon the fact that we are perhaps having a historical one of the lowest leverage in the corporate balance sheets right now. The corporate debt to GDP ratio in India is less than 60%, right? And from a private credit industry perspective, we are less than 1%, around 1% of the total corporate debt in India right now. All these things point out to the fact that there is a significant growth path which is available from a private credit industry perspective. Also, if you look at the enabling factors, there is a strong ecosystem which has gotten created in terms of regulations, in terms of the other enabling partners, trustees, etc., etc. IVC, and so many other factors which have created a very strong ecosystem around that. And as represented in this panel, there are so many strong established platforms which are there in India now who can make use of this opportunity. Given all this, I believe there is a structural growth story which is available as far as private credit is concerned. And given that story and the multifold growth which is potentially possible, I do not really see we are in an overcrowded space where there is a need for a consolidation. I think many people can come in, the industry can continue to grow, while the more established players will of course have a first mover advantage and the more to strongly continue to grow their business.
Fantastic. Yeah, you wanted to add something, Pranav?
Yeah, I just want to, it's a question that we hear very often in terms of deterioration or potential deterioration of credit quality. I just want to mention two statistics here, right? We're talking about a $4 trillion economy, give or take. We're talking about capital formation at 30% of GDP, which is like 1.2 trillion, give or take. Against that, anecdotally, this credit market that we are talking about, private credit, is all of $25 billion, right? So, it's a very, very long way to go, in a $3 trillion private credit market globally is basically the estimated number. The second thing, and I'm just drawing upon one of the points that Kirti made, right? Yes, bigger deals and, of course there is objectivity around that. When we look at the credit space in India, a lot of companies tend to be essentially smaller and upper, let's say, mid-market companies, right? And fundamentally, the capital need, the capital gap that we find, which runs into hundreds of billions of dollars, really speaks to these companies, right? So what tends to happen is that if you basically obviate, let's say, deals of below $15-20 million, you are essentially ruling out 90% of the white space insofar as basically the flow of credit deals in India is concerned. We being, a classically more mid-market focused fund in India and in Asia, tend to look at deals of, I would say, between 10 to 25 million would be the median size. which from a deal flow perspective, I would tend to say that, we have a very, very big funnel, and that funnel has not been prejudiced by, let's say, compromising on, credit quality or covenants or other such, at least till now, right? That's what I would observe.
Thanks, Pranav. Rohit, you have been investing in the private credit space, mid-market private credit for almost a decade now. Do you think you've seen it all? And do you still find any surprises in this business?
I think surprises is a way of life in private credit. I think, as you rightly pointed out, it's been 9 years for us in UTI Alternatives. And right from the launch of our first private credit fund, which happened in 2017, we immediately got into the ILFS crisis. And all of us here have, borne that challenge. And what ILFS did was it took away refinancing away from the market. Because our underwriting typically would tend to have a component of refinancing at the end of the tenor. So that vanished away from the market. And then we head straight into COVID-1, which I think, the human mindset is such that we forget the challenges that we faced in life. So COVID-1 was, I would like to remind everyone, everything shut down. For 3 months, we were looking and staring at our cash flows in the banks. Nothing was coming. And then we had COVID-2, where, we had Delta wave hitting us. And now coming forward, right now we're facing with the issue of what's going to happen if the Strait of Hormuz is closed for another week, 10 days, 2 weeks. And, we're sitting and analyzing our portfolio, stress testing it out and seeing, what will be the direct impact on certain companies, what will be the secondary impact, what will happen to the CPI, WPI, fiscal deficit, because frankly, that's what we have to deal with. I think what we realized that, investing is not a straight line, right? Whenever we start a fund or start a deal, we have a set of assumptions, a thesis, which invariably is tested by reality. Reality eventually, affects the underwriting. And what, as fund managers, our responsibility is to, absorb these surprises and not give a surprise to our investors. I think that's something that's been our focus area all this while. But I think one thing that I learned from the surprises is that, having a diversified portfolio is ultimately the best way to go about it. Keep it as diversified as possible. And really, nothing is better than, monitoring on a daily basis. I always say that, in private equity, you can probably invest and go and play golf. But in private credit, frankly, I don't think any of us is a golfer right now on the stage. So
that is music to my ears, Rohit, because I firmly believe this monitoring of investments to private credit is so important and sometimes underemphasized. I've seen in many cases people almost like treating it as a passive investment. It's not. I think it requires way more active monitoring, and that's how you can get returns which is higher yield, right? Eshwar, you wanted to add to that?
No, just reacting to Rohit's comment. In our business, we give the money and they go and play golf.
So, Yuha, if I may come to you, I think, what we have seen in India is that the domestic private credit managers have outpaced global funds, accounting for almost 2/3 of the total deal value in last year. According to you, what makes domestic fund managers here so active, and why we not seeing foreign funds increasing their participation, or foreign fund managers increasing their participation in India? What does it require, according to you?
First of all, thanks IVCA for having the opportunity to speak here and share our experience with you. Just maybe a few words on us, because when I got introduced, I don't know what kind of animals you're dealing with. And someone said it's like perpetual investors. We're a family office based out of in Germany, and it's for my colleague and myself a first trip to India. So we're sort of a greenhorns in this place. But that being said, our private debt program has been existent for some time, and we literally started actually last year deploying capital into Asia, and felt like that India is a kind of a single market exposure that it's worthwhile considering. Now, that being said, because that relates to your question, Ashish, is, we felt like the local content in India is very much pronounced as opposed to like other, let's say, Asian-Pac located markets. And it's also receiving a strong support, maybe also from a regulatory perspective, that capital cannot really be invested outside India because of the restrictions. But that being said, There's a strong support from the local investor base. And it's, my colleague and myself have been debating actually today morning, sitting outside the balcony terrace and saying everything is big in India, right? But the amount of investable managers are probably from a foreigner's perspective, probably not as in the same magnitude as you would guess. Now, what is the kind of a key ingredient? I think if you just compare like local managers, and we have a couple of esteemed panelists sitting here next to me, there are a couple of hundred people on ground doing their work and groundwork, sourcing, execution, and monitoring. And you got also global fund managers. But again, from their perspective, either you're based out of a US headquartered business and trying to tackle the market with, let's say, 10 or let's call it like 12, 15 people, they're doing different deals. But that being said, the access to the market is actually a key ingredient here, we feel. And it's really, really difficult to tackle it, I fear, because the structural imbalance is in the mid-market, right? In the upper end of the market, the way we see it, and the lower end, there's kind of a insufficient coverage from banks, but the mid-market itself is difficult to grasp. It's so fragmented, and you need to also understand, as my esteemed panelists actually pointed out, the complexity that's around the numbers here. Maybe I got it wrong, but they're nodding, so we learned our lessons.
Do you think it'll help if you have more feet on the street, more people in the on the ground here that will be able to identify those opportunities? Is that the differentiator?
I believe so. It's not a typical India phenomena, but I think we feel like in India it's even more pronounced. But you could also probably argue the same way for European low mid-market transactions, etc. Just as a side note, Pranab, when we had the kind of a catch up at the speakers lounge, he said, "Oh, you guys like the risky high octane stuff." I was thinking, it was a thoughtful statement. It's like, no, we're not. We're relative value investor, premium driven. But there's a point when we look at the kind of a flight route we took actually down here, flying over Iran, Afghanistan, Pakistan, and also kind of vaccine shots we got, because you'll excuse us, we're not really adapted to the kind of new environment. I think that's something risk to take, we'd love to take on.
Yeah, the first thing I asked Yuha when I met him this morning is that, how did you get here? I think it just right now seems to be a challenge, flying in and out of the West especially. So, Pranab, can I come to you, with this, taking on from what we just spoke about, his flight across Tehran and Iran. There's a rapid string of these tail risks that are playing out recently, whether it's geopolitics, whether it's tariff issues, whether it's, sharp input price moves, this can quickly dislocate, cash flows of a company, right? So from an asset allocation perspective, do you see this impact in the near term on the international funds which have been allocated, for private credit in emerging markets like India or Asia in general? Do you think this is going to, have a sort of a adverse impact on what we are seeing as a appetite for credit markets here?
So, I'll just...
or will the risk premiums rise?
No, absolutely. We've seen a host of events starting from, maybe Ukraine on 1 year and COVID the year before, and obviously a lot of, I would say, very, idiosyncratic dislocation insofar as where we are standing right now, right? Now, there are really 2-3 ways of looking at this from our perspective, right? One is that we tend to deal with cross-border investors, but we deal with investors with more flexible mandates, okay? HNIs, family offices, multi-family offices. So to that extent, they are flexible in terms of reallocating across asset classes and reallocating across geographies, right? So if they feel that for a moment, right, with no disservice to anyone, if the Middle East or West Asia is not the place to allocate at this moment, they will simply sort of, to the extent that they can, especially in more public and more semi-liquid asset classes, right, move their capital to, geographies which make more sense for them. In a more narrower context in terms of India, really 2-3 things, right? Of course, impact on CAD, inflation, all of that, right, spoken for, FX. In the shorter term, we would tend to find opportunities maybe in terms of some of the other liquidity or working capital dislocation. If your primary thesis is that this situation will sort of alleviate over a limited period of time, it does make sense to be constructive around some of those calls, right, in terms of seeing, if there's something in terms of a 3-6 month dislocation that you can play into in the credit space, right, especially for mid-market companies. In the longer term, right, I mean, what we've tended to see is basically there is practically a movement of supply chains altogether, right? Effectively, what you've seen in the China Plus strategy, right, maybe about 2 years back, wherein a lot of, basically because of geopolitics, a lot of supply chains started moving into maybe an India, maybe into a Vietnam, etc., right? Effectively, capital allocation moved away from an X to at least an X plus Y. If basically the broad spectrum of capital allocators start finding the predictability of geopolitics in a given quadrant unpredictable, they will move. And you can move with that and create certain allocation opportunities. The third and last thing, if I may, right, is basically this particular dislocation currently speaks to a third and unrelated thing to previous crisis, which is basically a dislocation in the energy market. And so that, to that extent, if this means something for example, the growth of renewables in India or other supply chains in terms of what exploration quadrants make sense at $100 a barrel, $120 a barrel, are also worth exploring in terms of those supply chains, right? I mean, that's the way we've been thinking about it, but it's a little early, honestly, right? It's very, very early.
I'd like, Ashish, I'd like to add another point to all that Pranav has said, is that we are forgetting the size of the US private credit market. The size of the US private credit market is $2 trillion as compared to our minuscule $25 billion. So when you're talking about global allocators, they are watching the private credit space very closely in the US. And given the recent spate of events which have been happening over there, I think they are concerned. And most of the global institutions are at least 50% invested in the US market. So the consequences of any default which happens there, even a small sneeze, and they'll just rethink about an emerging market called India, which is just some $25 billion. So that's a huge challenge.
No, absolutely. I think, that's something which...
one small point,
Yeah.
sorry. I agree. Global investors, when it comes to US and all, private credit is under scrutiny. But if you look at the IBC, the way it has developed over a period of time, so US bankruptcy code came in 1980. Private credit in US was significant only by, say, early 2000. Whereas in India, within 10 years, and given it's a fantastic job by our regulators, that we as a private credit player, as far as capital protection is concerned, now IBC is a very fantastic thing that has happened to India. And obviously the regulators are learning and we are also learning and we are providing feedback. So that is one. Secondly, the state of economy. When US bankruptcy code came in 1980, there I think the GDP was around $3 trillion. Right now they are at $30 trillion. At $30 trillion is $2 trillion. I'm looking at 20 years down the line. I'm not saying that we'll be like doing a 30 trillion, even at half. We are looking at an economy of $15 trillion. The percentage, half of that, what the US is right now, we are looking at a market of $1 trillion of private credit, which implies a CAGR of 20 plus for the next 20 years. And obviously, we will be learning from other geographies the mistakes that has been done so that we don't repeat it in India. And that's why the growth as such in private credit is going to be huge because there's a limited capital which banks can provide, which governments can provide. The money has to come from somewhere else in the form of private credit. Yes, India now to some extent is also, I will say, not very much dependent upon foreign capital, the way the equity market has sustained over the last couple of years. So the domestic money itself can sustain a good amount of private credit market. And obviously, because of diversification requirement, the offshore funds, they are looking at India and probably for diversification, for mitigation of risks, etc. India is a good place right now. And for next 20 years, it will be like there.
No, absolutely. And this is, what Kaushal and I were talking the other day. The US market is now 2 trillion, like you said, right? But, there are these rumors of potential markdowns, maybe a liquidity issue somewhere. The famous Blackstone example, which is being all over the media. Investors are taking slightly more skeptical, view on the valuation methodologies that are being put out. So, Kaushal, how would you compare this to the Indian, emerging private credit market, and do you anticipate these developments in the US, which of course is like the mother of all when it comes to the funds? do you think that'll have an impact on the Indian private credit landscape, and will it also, the investors here will question certain, methodologies? What do you see as the impact?
Sure. So Ashish, I think let's look at it 2-3 levels. Eshwar hinted at that. I think there could always be a immediate reaction to something happening. The investors might think of an event and try and reflect upon the same event from a different markets perspective as well. But I would want to use this opportunity to maybe just highlight a few points in context of how the Indian situation is very different in vis-a-vis where US stands today. A lot of the issues currently are also related to how the investment vehicle structures are kind of available in US. The two issues which we have heard lately of Blue Owl as well as BlackRock, both of them are related to BDCs, which are semi-liquid investment vehicles, right? I think the Indian context is very different. I think SEBI and the other regulators have been very prudent in terms of how they have thought about the entire landscape here. Most of the private credit in India happens from a AIF Cat 2, which are closed-ended funds, and which ensures that there is no significant asset liability mismatch as you are investing in illiquid assets, which are long-term assets. You shouldn't be staring at a situation where you're having a significant redemption demand. Also, I think importantly, the other 2-3 things which are maybe worth highlighting from an Indian context is the fact that the way Indian regulations are structured, there isn't much systemic risk also from the financial market perspective. Banks and NBFCs are highly restricted from investing into AIFs, right? Which means that any systemic risk emanating from a private credit event will not likely spill over to the other parts of the financial system. Also, very importantly, the way regulations are structured, the private credit space from a domestic perspective in India is largely invested into by either institutional capital or sophisticated capital, which is not open really for retail investors, right? Which also, in some sense, creates a more saner environment from a regulation perspective. But also to highlight, I think on the other side, the concern perhaps also comes from the quality of assets. I think you touched upon that earlier. To my mind, and some of the figures which I outlined earlier, definitely does suggest that from a private credit perspective, the penetration level is so low, and the opportunities are more than enough, I would argue, even now and maybe going forward as well, and point which Kirti also made, for us to not necessarily go down the credit curve. I don't think we are looking at curve light and many other other issues in context of asset quality in the Indian market right now, and I don't foresee that happening in the foreseeable future as well. I think the contexts are very different when we think about the Indian market vis-a-vis US. Of course, there could be some immediate reactions from some of the investors, but I think over a longer period of time, people will be able to differentiate between these markets.
I can see quite a few of us wanting to respond, to comment on
Yeah.
this. Yuha, maybe you first and then Rohit.
Yeah, sure. I'll just keep it short. So I think the way, those are actually interesting statements. I think comparing actually from a top-down perspective, high-level numbers, market size, etc., I think is valid. But the way we see it and looking through the lens of an, let's say, foreign-based investors, the way you need to actually see the Indian market is you cannot really directly compare the Western markets with the Indian markets to start with. Because, and you folks mentioned like BDCs, these are kind of beta strategies in our view. Because, and that's the interesting bit, right? If you look at the market sizing that you cited, I think it's interesting that the Indian market is still driven by idiosyncratic or secular situations, right? I mean, you mentioned like infrastructure-related investments or some special sits in your case. But we're not really talking about cash flow-based lending, which I think all the BDCs are actually about. And this is to us much more beta strategy related to much closer to the kind of fixed income markets, right? So in this respect, I think the pricing itself is a different animal here and a different approach to that. And I think also the complexity is different. If you look at from a cash flow-based lending, the complexity is actually huge because the upside is limited, whereas the downside is huge. You can lose the entire money. Whereas in some Indian situations, we figure, and just to give a kind of a outline, one of our managers, we're not in their funds, but they invest in music royalties, and they're one of the largest Bollywood catalog holders in the world because That's a different one. And then we looked at some cricket-related investing and was like, wow, that's actually the largest sports in this world, right? And this open eyes. But again, we haven't really come across, an, let's say, specific cash flow-based lending. There are only very few that does that. And that you can see that the return, let's say, convergence actually towards the Western market, what you see. So I just wanted to highlight here.
Can I just touch upon that point, because it's something very close to our heart.
You want to do the pitch now or tomorrow?
So I think we've not really spoken too much about this on this panel, Huan, but just to also highlight, I think I represent a performing credit cash flow backed lending firm. I do think that the opportunity and the real growth path for that kind of a business is extremely strong in the Indian context. Of course, we do not have time to go into details right now, but I do want to emphasize that that's also a very strong part of the entire private credit space in India. And we have as a firm, and I'm sure overall as a space, it has also seen a significant growth over the last few years and shall continue.
I agree. And I would bet actually 100 rupees that the software exposure has in India has a different risk profile than, for example, in the US or Europe these days, I bet. Who wants to bet with me?
Yeah, so just adding on to what's been discussed. So I think we also did an internal assessment and we realized the average turn of debt EBITDA that we look at total leverage in India is still much lower than the markets in US and Europe. Because, very frequently when I'm pitching to an international investor, they say, listen, but in Europe we're making 10% dollar return, and, we can't come to an emerging market where you're not giving us, more than that. Then we did the analysis and realized that we're much more conservative when we do our lending. So I think that's one difference. The asset quality is much better here. That's our assessment. And the second thing is, obviously, we are doing closed-ended funds, right, where liquidity is not an option. I think, as, Kaushal, you also talked about, right, that asset liability mismatch is the single biggest risk that you carry as a private credit manager.
Yes, I don't think it is so much about the quality of the investment. It's more about the liquidity is where the questions are rising. I think, Eshwar, you wanted to comment on this?
Yeah, another point is that, one is, of course, the liquidity, that ours are all closed-ended funds. So we don't have what we are calling as the evergreen funds, where on the liability side, you are probably T+2 or quarter on quarter. And on the asset side, you really don't know when you're going to get your money back. And we also have make-wholes and other stuff. I think the other very, very important point is that in our private credit market, our covenants are extremely strong. I don't know whether you all have had a chance to look at, the covenants and the documents of any of the private credit transactions in the US, but they are all just one sheet of paper. We go through our process, and in any transaction, and I'm sure I speak for all the rest of the people on this panel, that for any transaction that we underwrite, we take probably 4 months to consummate a transaction? No, 4 months?
At least.
At least 4 months. So that's the level of documentation, governance, and the security package that we undergo. But I don't think that's anywhere close to what is in the rest of the world.
And just to add, majority of the high yield market in US and Europe, those are convertibles and unsecured bonds. Here in India, unsecured, no, we are not going to do it. It's all secured.
Pranav?
See, I think, we talk about risk stress growing in the private credit market. We also talk, paradoxically about the growth of the Cat 2 AIF as a category. It has effectively quintupled over the last 5-6 years, right? To give or take 14 lakh crores, $140 billion. This is in the backdrop of, I would say, the largest liquidity infusion post-COVID that the Indian balance sheets have ever seen, right? Large corporates, upper mid-market corporates, etc. So we don't believe that, the fundamental reason for the emergence of this private credit market in India is essentially on account of, let's say, a fundamental systemic stress, right, on corporate balance sheets, right? It has come from what we use as a very hackneyed term, which is non-bankable end use. Banks can't do certain things by regulation, which includes a bunch of things around capital market exposure, domestic acquisitions, equity purchases, etc. The other thing to note in terms of exit is, apart from cash flow, we have also seen, I'm not speaking for perhaps the last maybe few months, but some of the most vibrant capital markets, some of the most high IPO momentum, right, and secondary market momentum that India has ever seen in its history. that has also provided a natural conduit in terms of repricing risk as well as exiting private credit positions. If you've loaded on 18-20% debt on a good corporate, right, then there is absolutely no, prerogative more, sort of important for him than to get it off his books at the, I would say earliest possible opportunity, right? So that's the way we've been seeing it.
Great, thank you. Thank you. I'm conscious of the timer right in front of me. We are almost at the end of time, and this conversation could just go on, and I'm sure we didn't leave any time for the audience to ask questions here. Some of these experts will be available here for some more time at least, and please feel free to get in touch with them. I think I've been told the time is up, and I still have a few questions I wanted to ask, but fortunately I'll reach out to you guys privately outside in coffee. Thank you so much, and thank you all for your patience.